Namaskara and welcome to this episode of Keeping Wealth Wise. I'm Vasanthi Hari Prakash with you, your host. And what I hope is that those of you who are watching us, who are listening to us, will take away really insights of wisdom of keeping wealth wise. And without further ado, I'm going to introduce the two guests who are quite steeped in this, whose whole, I would say, career and lifetime experience is to do with wealth and all the entire spectrum. I have great pleasure in introducing, first of all, Shashank Khade with us. Shashank, welcome to the show.
Hi, Vasanthi. Thanks for having me here.
So, as the CIO, as the person who is the equity specialist of Entrust, coming with more than a quarter century of cumulative and professional experience, both in listed and unlisted equity investment management. So, Shashank, what's a day in your life like?
Yeah, of course. Till 3:30 it is listed, and beyond that it is that's right. So we keep toggling between both the markets, and it's actually wonderful to see both sides of the world. These are two different, absolute different worlds, but enjoying them thoroughly, both of them.
Wonderful. In fact, like we speak about asset allocation, your day allocation seems just as interesting. I'm going to now welcome Dr. Karthik S., my other guest on the show. Hi, Karthik.
Hi, Vasanthi. Thank you for having us here.
What I also have before me, which I would like to really read from for those who are watching us, is it more than 21 years, but I think I would almost close to 25 years, I would say, as what your colleagues were telling me, in the financial services industry. And that is spread across a portfolio of retail lending, insurance, mutual funds, and wealth management. Which means, Karthik, you have the secret, kind of grail on how a person can become an HNI very soon.
Yeah, I mean, I was lucky enough to have actually seen the complete spectrum in the financial services. So, right from the lending side of it to risk management to investment management and advisory and so on and so forth. The passion has always been in terms of helping our clients. So, the wealth of experience that I've had for all these years definitely comes in handy when I deal with my clients and try to manage their portfolios.
As we go along with this conversation, I'd like to ask both of you, even about your experiences in general before interest happened to both of you. For instance, Karthik, you've been associated with companies like Kotak Mahindra Asset Management, Morgan Stanley Investment Management, and Sanctum Wealth Management. So I'm going to ask you this question: what's different about the way what you do at Interest?
The profile and the job responsibilities are something very close to my heart because Entrust as an organization, the approach is very fiduciary in the relationship that we have with our clients. So here, there's absolutely nothing of any linkages to product selling or trying to push any particular product into client portfolios. This is thorough, purebred, investment management, which is completely in the interest of the client. So it gives you a lot of joy in terms of the philosophical approach, the ethical bent. All of these things gives you a lot of joy and experience in terms of managing client portfolios. I think that is the biggest draw, and the philosophy runs right from the founders, right down to each and every employee over here. So the beauty of this setup is that all of us have a similar thought process and goal and an approach when it comes up to helping our clients achieve their objectives.
See, what I heard, especially when you say the word philosophy, that I think is just as important, and not pushing products, that for sure. Coming to you, Shashank, before you actually co-founded Entrust, you were the senior vice president and head of portfolio management services division of Kotak Mutual Fund. Now, that's a position I could see, from what's written, that you held for 7 years between 2006 and 13, by the end of which you were managing 2,000 crore INR, that is across various portfolio management schemes. So, why the move from there to what you do now?
Yeah, so this was at Kotak again on the portfolio management side. So if one were to look at, it was a mix of both private equity and portfolio management experience. So having seen both the worlds, I just thought Entrust could be a great place where the blend of both the experiences can be put to use. And that's exactly how it has shaped up. Both I've been, using my skills, of consummation, of private equity investments, as well as on the listed side, I've got a chance to, manage money for investors. So that gives me satisfaction that, whatever I have done in my career, is something which has come handy.
So, one of the fundamental things to understand is how do you onboard a client? And Karthik, I'm going to ask you to take us through this journey. It's almost like a simulation of what you say, what you do, what you examine as a process. So, yeah, waiting to hear from you on that.
The first thing that we would like to understand from a client who is engaging with us is what is the role that they want us to play. Do they want us to be a guard dog? In which case, what we will do is we will act as a filter, analyze every opportunity that is coming their way, and only send through the ones which is more relevant for the client, since we have a better understanding of the client. The other way to look at it is, do they want us to be the lead player over there? In which case, what we do is, we bring in our own philosophy, we bring in our own customization to the client's portfolio and manage it solely from our end. The third way is for us to play a role of a super advisor. So, where a portion of the portfolio is managed by us based on our philosophical approach. And at the same time, we also play the role of a guardian. These are the three ways we engage with our client, and which essentially means that we're not a competition for anyone. We only play on the side of the client, so whatever be the requirement the client has, we would play according to that. In this, what's pertinent is we understand the risk profile of a client. We develop an investment policy statement after a deeper engagement and deliberation to understand various contours and nitty-gritties of how they want to take things ahead. We go to the extent of understanding the cash flow requirements, we understand their goals, we understand their risk profile, and then we move down to doing a sort of an audit of their existing portfolio, see if this portfolio is in line with what their objective is and the risk profile is. If not, then we will start advising on what kind of changes needs to be implemented over what period of time, and thereby go about navigating the overall portfolio management from there on. So it's a very comprehensive approach that we follow. Unlike just coming and saying that a particular opportunity or a product looks very attractive and has a promise of delivering fantastic return, we look at the overall portfolio, the past journey, the psyche of the client, the objective of the client, and then match each and every opportunity and size it accordingly to manage the portfolio going forward. That's in brief of everything that we kind of do throughout the journey. And there's constant monitoring and communication and feedback, which is very important. Transparency, feedback, constant monitoring, review, all of this is built as a part of a practice whereby the client is, at any point in time, he doesn't feel disconnected. He feels completely connected, understands which way we are navigating the overall investment advisory business. Shall you add anything more to it?
And Karthik, the risk profile is also tested from time to time, right?
Absolutely. So every 2 years or basis any kind of a major life event, we would test the risk profile. The investment policy statement also accordingly would go through a revision, because circumstances change, situations change, thought processes change. We have to update that on a regular basis to ensure that it's relevant as we go about managing it.
So assume that I am that client, that absolutely ultra rich client who has always been skeptical, who's been dealing with various wealth managers, but I heard about Entrust and I picked the phone call on you, and here I am at Entrust.
So glad to have you on board, Vasanthi. I mean, it'll be a pleasure to actually serve you on the investment journey. Just a couple of questions. What has been your past experience with your investments, and what is it that you really propose to have as an objective for this investment journey of yours?
Karthik, I would say that I've been very, very suspicious of anybody who has approached me, because it's not easy to handle 1,000 crore of wealth, and just be the custodian. And I see my responsibility, but at the same time, I'm always wary of people who claim that they are serving my best interest, because I'm never sure about the products they're pushing. I'm never sure about the allocation that they're advising me. I don't even know whether you have the right solution for all that.
But I can tell you confidently that you've come to the right place, because this is exactly what we do on a day-to-day basis. Try and, decipher the whole journey, and in fact partner with you as a client in this journey of investment management. So unlike any of the other players that you've met in the past, the difference here is that we'd like to be a part of this family, and that's why we call ourselves as family office, and help you achieve that. So, Vasanthi, the other aspect that I would like to understand is, even before we go about telling you how to manage this wealth, or which direction we are going to take, we would like to first understand where all you've invested, and try and see if that's a right fit from your risk profile standpoint and your investment objective standpoint. So, what is your thought process? I mean, do you think you've ever received some sort of an advice till now on the investment journey, which focuses on a holistic standpoint, which focuses on your investment objective, which is aligned to what your risk attitude is?
So I will say one thing that my specific interest now is with unlisted. I'm told that your senior colleague Shashank is somebody who really looks at that. So between the two of you, if I could even ask Shashank, how does one make, let's say, a debut into the unlisted side, given that I'm moderately, risk taking.
Sure. So, ma'am, there are two ways of investing on the unlisted side. One is you invest in a fund, which has a fund life of between 8 to 12 years. You get to know the outcome, after 8 to 12 years, which means that part of your wealth will be relatively illiquid, and you will possibly get the fruits after that period. What we have done for our clients is that we've started to invest directly in companies, so that the outcome or the investment horizon what we seek in these investments is far lesser than 8 to 10 years, and we're looking at between 3 to 5 years as an optimum investment horizon, where an investor can invest in an unlisted company and also get the results during that period. Thanks to that, what you can possibly get is understand what companies you've invested in, and most importantly, look at a shifter exit as compared to a fund which could typically give you money after a decade or so. So
I see.
that's the reason why we've been empowering investors to invest in companies wherein their contributions may be far lower or smaller than a fund per se, but we would try and create a portfolio for you of unlisted companies so that you diversify your risk across various unlisted companies, and at the same time do not have so much exposure to one company per se.
Do not have exposure to one company. So I'm going to keep that in mind. Meanwhile, I would like to thank the two of you for really playing along with the client role play that we did. The idea was also to give our viewers a real sense of how family offices would actually do things when it comes to wealth management. But Shashank, coming back to you, when somebody who's actually been part of a bigger brand such as what your work was. Now, do you really think that they're not able to handle this level of, let's say, needs of the HNIs, that they should actually look at family offices? Where exactly is the fundamental gap that companies like you try to address?
So I think it's all about customization. So if you're handling clients, not necessarily all the investors are as evolved, to invest in companies directly. The needs are different from client to client. It all depends on the risk profile of the client, his understanding, most importantly, of equities. And and there are investors who just get themselves invested on the listed side, and they say that we would not like to take the risk of unlisted equities at all. So,
Exactly.
so you need to tailor your strategies as per what the client needs are, and because if you have a fully established team, clearly these are overheads for any company, which means that you have to conceptualize a product and push it to investors. So if you do that, invariably what happens is it gets pushed to all sorts of clients who may or may not really want to invest in those type of products. Whereas given the fact that we are a boutique house, we could only direct it to clients who actually should be investing in unlisted companies. So that's the key difference. And again, we have sort of coined the investment horizon. People really don't do that. A lot of people have misconceptions about startups and investing and get carried away. We have measured risk. We've looked at how much fatigue gets developed over what period. Now, typically people, when they approach us, they say that 5 years I'm thinking long term and I'm good for 5 years to invest in companies. But our sense is that the investment, the fatigue starts coming up in 3 years itself. The investor gets bored. He starts thinking about when will I really get the exit from a company. So we
Right.
looked at companies which can sort of give you an exit in less than 5 years. And those are the type of businesses at that stage is what we would love to invest in, so that the probability of an exit is very high over that.
But it's true. Like one can picture this, and especially when you're talking about the risk and in unlisted, but internally within your family, multifamily office, what is the, let's say, safety net? Now, let's say if for instance, Karthik, you were to advise a client about certain portfolio, then how is the client going to be very, very sure and have that faith that it is really in their best interest? I mean, is it like that you have a group of people weighing in on every investment that you do for a client?
Yes, in fact, process is extremely important when it comes up to managing wealth, right? And when you want someone to play on your side, you want to ensure that they have the right set of skill set, they have a governance mechanism, and they're doing it completely in your interest. So the way we have set up certain processes over here is, on one hand, when we are trying to take certain investment decisions, while we act as enablers for our clients, these investment decisions are completely based on a robust research, database approach. At the same time, it is not something which just comes from one individual or a team. It's an organizational effort. So we've
Hmm.
set a very strong investment committee process. So any sort of a broad investment thesis in terms of, it could be an action, it could be a strategy that you want to build into client portfolios, it gets deliberated in the investment committee. And with the guidance and approach from the investment committee is when we kind of take it to the client. One way
Hmm.
of a guardrail that we have. The other way you could look at it is, clients nowadays get a lot of investment opportunities thrown at them, right? I mean, the network is there, and you get, at some point in time, the client gets a little overwhelmed on the fact that, are we missing some opportunities? Is this really the right opportunity to look at?
Right.
There could be flavors of the season which kind of, sounds very enticing, but is it really the right one? So what we do is, we act as guardians for the client's wealth. That's how we would like to look at ourselves as. So something like a sentinel, and we kind of have a very robust due diligence process for every strategy, for every manager, for every product. And we do not compromise on this approach of due diligence. So we filter out every such opportunity which comes through the client through a robust due diligence process, and ensure that this opportunity is suitable or not suitable for a particular client. So it's not something which is uniform. It could be suitable for
Hmm.
one client and may not be suitable for the other client. And that's where Shashank was talking about making it very customized and bespoke. That kind of an approach is applied.
So let me give you two scenarios for both of you. Now, let's say there's a client who comes in very with great clarity about what she wants, and you believe that at least there are some of those which will work well, and some which are very risky. I mean, which is not probably the kind of return yielding as she thinks. Then how? What kind of convincing does it take? What are the tools that you use to convince the client that this is not the right thing for them?
So, on one hand, when we talk about suitability, we cannot forget the long term objective the client has set for the portfolio. So, great returns could be a myopic view. It needs to be tested from a data perspective. You also have to look at how much of allocation of that kind of a risky product, because with higher returns, you always tag along higher risk, right? They're like twins. Whether the risk plays out or no is something that you will have to assess. So we kind of, put that scenario analysis in place, and we try to look at the exposure limits within the portfolio to ensure that in case the risk plays out, will that derail the whole objective, investment objective, or the way the portfolio has been going for all these days? Will that act as a derailment to that? So you have to look at the sensitivity analysis of a particular opportunity within the overall portfolio framework before you, kind of go about deciding whether it makes sense or
And
not.
I'm just a bit curious.
add,
Sorry, after you, Shashank.
yeah, so every client is the profile of his risk is measured at the start itself. So say let's assume you come in as a client, we'll try and assess your risk taking capabilities. And based on that, Karthik will possibly draw out a plan based on an asset allocation between debt, equity, various assets, precious metals, all of it. And it all depends on your risk. Now, for example, there are two types of clients who may come in. A smaller, wealthier client may come and say, I want to grow my wealth aggressively. Can you,
Exactly.
double my wealth in the next 5 years? And what sort of drawdowns can you really absorb in those 5 years is what question we would try and understand. It's great to say, can I double my money in 3 years or 5 years? But what sort of risk do you want to take? So our job is to, there are two ways of looking at this, right? How much downsides can you, take, and how much upsides do you want? Now, both don't go hand in hand. If you're taking higher, if you aspire for higher returns, which means that inherently you are aspiring for higher risk as well, you can take those drawdowns. No, so there are two type of clients. One is a large client who comes in, who has a sufficient net worth. He says that I want to grow my net worth in a steady state manner. If you give me 15% compounding, I'm happy. Okay. Then the other client, the smaller client, will come and say that here I am. I am an aspirant. I want to be, at least $100 million plus in the next 3 years. Can you help me grow my capital? Now, that will be a different approach altogether. A 15% IRR versus, say, a 20 or a 25% IRR, both the asset allocations will be very different.
Hmm.
Drawdowns in both the cases will be completely different. So, it all depends what exactly does the client need. But the most important point, which Karthik and also can possibly dwell on, is that we keep harping on the fact that how much risk are you going to really take to generate those returns? That's what precisely we do in our, IC, meetings. Is that what is the risk involved here? We don't look at, how much can you make. We actually look at, for that those returns, how much risk are you taking?
Right. Right. But ultimately, the decision rests with the client, of course. Probably they might, I mean, even if in the best of interest that you've given those advice, there may be times when they overrule, and you have to go with the client's. I mean, ultimately, I'm guessing, even let's say a not so right decision at that point of time. My curiosity was that you will then have to work with something which has been handed over to you despite your advice. And how does that pan out?
So it's quite simple, right? I mean, you are playing the role of an advisor, a consultant, a coach, sorts, right? And you're helping the client, or you're enabling the client to take the decision based on data points. Now, typically, when it comes up to investment, an aspect which is usually ignored by a lot of them or not looked in by a lot of them is emotional biases, right? If a client is looking at a particular opportunity, it's very pertinent that we try to understand whether it's the recency bias which is playing on him. Is there an anchoring bias which is playing on him? So when you have a party like Entrust, what we try to do is we try to fill up those gaps of emotional biases. We don't look at it with the same emotional bias that the client is looking at.
Right.
And then you try to give an extremely objective view of whether it makes sense. But at the end of the day, it's the client's money. The client is
Yeah.
taking the risk, right? So if the client takes the risk on that particular investment, then we have to continue to monitor and red flag as and when we feel that the risk is going to be playing out, and maybe take suitable actions or help the client take suitable action to minimize the damage when the risk plays out. So that's how we would normally go about managing it. The decision making ultimately lies with the client. We are enablers of sorts. That's the role that we would like to play.
Yeah. So, for instance, Shashank, someone could ask you for crypto, Bitcoin, and I mean, it's all out there in the universe as options. Now, the onus is on you to kind of steer that person towards the right path.
So, in that case, we may have strong reservations against investing in, certain assets like these. And we have to cogently explain to the investor why he should not be investing. Okay. We do not really then focus on, the upsides. But if there is an asset where we can't understand the underlying, we have to explain to the client that, you're actually taking a big risk. It's a binary outcome. Either you make a lot of money or you're going to lose all your capital. So, all these risks have to be explained to the investor. It may sound very boring to the investor, but we have to bring him down to senses, saying that that's a risk which you carry. And normally investors appreciate this, because even if they go ahead, overstepping this advice, they later, come back and say, fine, I mean, you guys had told me not to invest in it, but still I went ahead. So the onus is clearly on the investor when he does, all of these sort of investments.
So we've dealt with in this segment some very actual questions of what clients, what advice you give to clients, and how you do the due diligence, have those red flags. I'm now going to ask for us to spend the next, like, say, 5 to 10 minutes about the psychology of an investor, psychology of someone who's on their way to build wealth, probably even legacy. As you mentioned, Karthik, people have different needs. I'm sure there's probably, if there is old wealth in the family, they might, for example, veer towards philanthropy, or even if it's recent, I see a whole lot of names. I mean, being a journalist, I'm always in awe of people who also would like to do that giving just as they are getting. I was moderating a conversation on Indians giving. I mean, this was with Rohini Nilekani philanthropies, and the way that people would also like to give back. So is that give back also built into the, let's say, asset allocation? Is that something that people come to you with?
Yeah, absolutely. See, there are two ways the giving back happens. One, if they create a bucket specifically for philanthropic needs and they define what kind of cost they want to really support. And you could do that by virtue of creating a trust, monitoring it, looking at the deployments, and so on and so forth. That's one way of looking at it. So then the amount that's been invested into the trust for that philanthropic purpose has to be managed in a way that it's sustainable, and the philanthropic initiative runs through for many years on the support of that corpus that's been set aside. That's one way of looking at it. The other way of looking at it, while philanthropy is on the high spectrum, there are investment objectives that we've seen clients come with, saying that they would like to have social impact investing.
Right.
And there are various causes that you could do. I mean, these are not places where you're not looking at returns. You're looking at maybe a marginally lower level of return, but still you want the return to be tagged along with some kind of a social impact. So this can be where you're trying to help marginal business people in rural areas. This can be education related, this could be microfinance related, this could be something even related to carbon credits, right, which is more environmental friendly. So what we do essentially is we always look at these aspirations that clients have while they're looking at growing the wealth. If they're looking at also having a social impact through that, we build in that within the portfolio construct and actively scout for opportunities which is more in alignment with what they have as a philosophy or what is close to their heart from a social impact standpoint.
So, Shashank, moving further in this, just to delve into the psychology, as I was saying, so what do typically ultra high net worth individuals seek in their investment journeys, in your years of experience? How do it's would be good to understand that.
See, most of the investors, if you ask me, want to enjoy the creation of wealth. Okay, the process of creation. Some of the investors want to be involved. They want to understand, how we are doing it, what sort of risk we are taking. So they would love to enjoy it. And now you've seen families where the next generation has come in. The next generation will bring in a different perspective altogether. They would like, the wealth to be managed in a different way as compared, to the senior generation.
I'm sure. Yeah.
There are these twists and turns which we need to really manage when we are looking at, creating wealth for the family. So while, the senior would be, sort of convinced on how we are managing it, the juniors in the family would want it to be far more aggressive, far more dynamic. They would love to invest in cryptos and startups, early stage venture capital, seed stage. So it will be a different world altogether. But we've seen these needs in a family evolve. And most of the families are going through this transition where the next generation wants to be invested in a completely different way. So the challenge, family office provider like us comes in, wherein that you need to steer your management in a way and be flexible to take care of the needs of each and every family member. So if the next
In a meeting, or whether it's in their home setting or wherever theirs or your office setting, do many of these generations come together for such meetings, actually sit through these?
yeah, they do. And then at times we realize that once we've understood that they are completely different in terms of how they're thinking, then we need to really manage them separately rather than as collectively as one family, which means that these are not one single mandate, these are multiple mandates within the family itself. But then you have to handle them completely and we've seen within the younger generations also, two members will have completely different perspective in terms of what they want to really do with the wealth what they have received. So it becomes very interesting, but it is good learning for us. But these are multiple clients within one family itself.
So wealth, helping people manage their wealth, is not just being on top of knowledge about instruments of wealth, but also understanding the mind.
The psyche.
Yeah.
Yes.
Yeah, the psyche. How do you keep yourself updated, Karthik, if I may ask you that?
So the whole thing is when we start interacting with our clients, the family members, I mean, it's so diverse. You kind of hit upon various kind of psyches and you understand them in better light, right? And what's more important, it's not just the psyche, but also the interplay between that. And how are you trying to weave them together when you're looking at managing the family's investment portfolio? Like, for example, just to add on to what Shashank was saying, you could probably have a patriarch who's built wealth by virtue of building business or organization, right, over many decades. The next generation may not be really taking that path of trying to build a business, but rather they would like to do it indirectly by investing into startups. And you're diversifying the same thing. I mean, they're achieving that in some form in terms of supporting a lot of other startups in different segments and sectors, but they may not be directly involved in the management and strategy and building that business. So the
Right,
approach that the earlier generation and the next generation takes is very different, and that's also because the ecosystem has changed so much, right?
right.
The earlier generation may not have had these opportunities of tapping into newer startups or investment vehicles available for them to start investing through that. The younger generation today has that many more options, and it can also be spread across geographies. It's just not restricted to India as an investment destination. So today, cross-border investing has become quite seamless, and so from that perspective, we're seeing a completely different flair. We've seen evolution of how the investment landscape is transformed, and in similar lines, we've also seen how generational thought processes and approaches towards investments have been changing over a period of time.
So so Vasanthi, we get different types of situations within families. While a traditional way of doing asset allocation is measuring how much equity do you really need to grow the overall net worth of the client, how much do you need safety in debt, and then of course there are alternative assets and precious metals what we deploy. But there are families who come in with their fixed notions. The older generation come in saying that we have comfort in a certain asset. So, for example, a family office, we approached a family. They, in fact, said that we are very comfortable with real estate assets, hard assets on the ground. With 50% of our net worth should be in it. It should be yielding income though. But that is 50%, and the rest 50%, can you draw an asset allocation plan such that we achieve our goals in the next few years. So we get different situation. We also had startup founders, okay, the guys who have actually made money by selling companies coming to us and saying that can you manage wealth for us, but it has to be substantially investing back into startups. So can you help us consummate those transactions as well? So these are different situations what we get where families have different perspective in terms of how wealth should be managed.
I think very interesting case to case. But then again, coming to you, there are those who are absolutely ultra high net worth individuals. A family wealth is running into multiples of thousands of crores. Probably it makes sense to have their own family office. Like I was reading elsewhere about the Federer family office, for instance. Now, then there are those who have wealth managers. Now, where is this multi-family office actually coming in or making sense for which kind of scenario?
So it's basically the bridge. It gives you the best of both worlds. Now, for someone to set up a single family office, the first requirement is that huge threshold of wealth.
Hmm.
And it involves a lot of cost for you to actually set up that. But the objective is what? The objective is that you're getting something which is under your control. You're getting a lot of transparency. You're getting a lot of understanding of how it's being managed. And more importantly, it's a no conflict model. I mean, you own the family
What do you mean by that?
in the sense everything that's being done from an investment standpoint is keeping the client and his family as the main beneficiary, right? I mean, you do not have any other relationship other than a principal and agent relationship. So the principal is the family.
There is no vested interest in recommending a particular instrument or allocation at all.
Absolutely. There's no other vested interest involved in that. Now, what happens in a multifamily office is even if you're not of that threshold, but you're in the journey of coming to that level of wealth, you have something which gives you all the benefits and positives of a single family office. So, a multifamily office has set up the whole unit. You have various departments. You have the estate planning department, you have the succession planning, you have the accounting part of it, you have the tax part of it, you have the investment part of it. So everything that a single family office does, you have it set up. It's a plug and play model, and you
Hmm.
just have to kind of attach yourself to that, and you get the same customization benefit, you get the same transparency benefit, you get the same no conflict model benefit
Got
that
it.
single family office gives you at a far lower cost and more efficient. And there's one more advantage. A larger advantage is that when you have a multifamily office, it's basically look at it like a congregation of number of families of similar profile, right?
Hmm.
Now,
Hmm.
each of the family have their own network. So opportunities that comes to one family can actually be benefiting another family as well, if
Right.
similar thought process. So the collaborative effect and the synergetic effect of a multifamily office can actually be something which can create an edge even over a single family office at times. So it fills in a lot of gap. And I think globally as well as in India, this is a space which is really in vogue and it'll continue to grow to a large extent. People
So,
are evolving and coming to multifamily offices compared to a traditional wealth management.
So what I'm because I mean, in a way, you've answered it because I was looking at some data, for instance, and where there actually, the mutual funds have generally done better, for example, in many of the project this thing. I mean, I had some of this data, and how do you generally make a case, therefore, right? So that was what a question that I had when somebody asks you that, okay, if I were to just put it directly in those, then that seems to be fetching better dividends, but then you probably have to do that extra convincing to that client.
So I'll tell you, mutual fund is a wrapper, right? Ultimately, what are you looking at? You're looking at the strategy, you're looking at the efficiency of the fund manager in terms of navigating this market
Hmm.
from time to time. And when you have close to about 50 odd mutual fund houses, and each of them having a plethora of schemes, how would you as an investor identify which is the strategy that you have to tap into at what point in time? Entry is largely easier, right? I mean, you could have, let's say, you could have your own gut on a particular strategy. But what's more important and which very seldom comes across as an advice is when to exit a particular investment, right? So, as a multifamily office setup, and especially the investment engine that we have created over here, we give equal importance to all of these things. We are agnostic when it comes up to wrapper. If
Hmm.
mutual fund benefits in a particular strategy, it's more cost efficient and more tax efficient, we wouldn't mind looking at that as an opportunity. But if there are certain niche strategies which are looking very attractive, have a prospect, and it's not available in mutual fund, as a family office, what we do is we go that extra mile of curating a product or a strategy, then ensuring that that gets patched into a client's portfolio. And we've done
So,
this number of times.
got it. So, which means, Shashank, that let's say when it comes to listed investments, you have a particular approach. Do you want to tell us about that?
Yeah. So on the listed side, since we handle both the worlds, unlisted and listed, the key difference here is, the listed side clearly is a set of companies which generate cash flows on a sustained basis. On the unlisted side, you'll definitely see the companies which are starved of capital and they continue to require capital on an ongoing basis. That's the key difference. Now, once you look at the listed space, it's very clear there are two approaches. One is either you do growth investing or you do value investing. We have tried to blend both the approaches together and
I
look
see.
at growth as at a reasonable value. That's what essentially premise is. See, India is a growth market, and you are investing in India because there is growth in earnings. So it's very clear that the earnings of companies, if you're able to get hold of at a reasonable price, you are definitely going to make money. So we keep looking at aspects, and everyone really looks at strong balance sheets, cash flow generation, working capital cycles, need to be neat and tidy. Those normal aspects and the return ratios have to be much higher or trending up. All these aspects we keep looking at when we identify a business. But most importantly, we also look at companies which are over-owned or under-owned. We do not like to get into crowded spaces because
Mm.
that normally tends to lead to suboptimal returns. When you have an under-owned space and you identify the space at an early stage and growth in earnings takes place thereafter, you actually benefit out of earnings growth plus a PE expansion. And that's
Mm.
what we are really looking at when we invest in a listed space. So identifying companies early, spot them early, wait for growth to pan out, and then take the benefits of re-rating thanks to the people crowding into the companies is what a proper cycle should be. And if you're able to achieve that cycle, then it renders great results for our investors. But it's very clear it's long-term investing. We do not advocate short-term for sure. Idea is that we will not get into momentum trading at all. But idea here is, can we really identify a good business at a good time? And that's
Hmm.
key to investing on the listed side.
So, the past few minutes or almost the entire gamut of conversation, ranging from how do you bring somebody on board to entrust their wealth with you, to be grown, to leave a legacy, to also deploy it for social good, for social impact, also to understand what is the human psychology behind investing, what is the generational difference, and what is the generational connect that you all keep within your span of work. We've really covered quite some ground. So at the end, I want to know what's the role model philosophy. I mean, what's a role model investor for each of you? I mean, this is a very personal question. Apart from the work that you do, who has inspired you in your line of work? It could be somebody who is probably not even present in this generation. It could be even a Warren Buffett, because his philosophy, investment philosophy, there's just so much online, for example, right? There's so many people who keep referring to that. But I want to know who has influenced and inspired each of you in your line of work. It could be within the family or outside. Shashank, you first.
No, I think there's Warren Buffett, of course, is always respected by all the investors. But I think closer home has been two good classical examples. One is Mr. Radhakishan Damani, who has built a business. So he started from trading, went on to investing at an early stage, and then thereafter he's actually been able to build a business and generate wealth. I think he's seen, if one way to look at in how a person evolved, he's actually from trading to being an investor to becoming an entrepreneur. He's actually worn all the hats. So I'm absolutely amazed how I can transition into all these roles in his journey of 20-25 years itself.
So Karthik, when it comes to you, who is that similar
I
inspirer and role model?
I wouldn't want to single out a person. That's because when you talk about investment, there are various styles. There's growth style, there's value, there's GARP, you know. and each of the style has its own pros and cons, and at different points in time, each of it gets played out. So for me, I would say I'm an ekalavya with multiple gurus rather than singling out one. Of course, all the
But among them, who's the Dronacharya? I want to know.
I think from a value investment standpoint, obviously it is Warren Buffett, and there's no one who can say no to it. Benjamin Graham is his guru, and that's where he's pulled in. And Charles Munger, the kind of thought process he brings in, that's again phenomenal. Close home, I think Rakesh Junjunwala, Radhakrishnan Damani, these are all the names that anyone would take. So I wouldn't want to single out one, but I always tend to learn something from everyone and try and see which of that can be applied in your thought process. And this philosophy is what we use in managing client wealth. We don't try to gravitate towards just one aspect, because every client is different, and every client requires a plethora of strategies to be stitched together.
Yeah.
You cannot kind of lean towards one, and then you have to be someone who's adaptable for every client in every situation, right? I mean, that's the job that we are at. So that's the whole idea of having multiple gurus and learning from
So, given that you are the Ekalavya, you're drawing from multiple astras in your arsenal, and yeah, great, great. Thank you so much. It's a hope that as much fun that we've had in discussing these very deeper aspects in this podcast of keeping wealth wise, there are those who either decide to actually invest their wealth, or at least there is an aspiration created for one day to be there. That's the hope that I personally have. Is there anything in closing that both of you would like to say?
No, I think we are enjoying the journey what we are at right now at Entrust, and understanding investor philosophy, the psyche of the investors and how they react. The investment behavior is what we are enjoying in terms of understanding how it unfolds. For various clients.
Right.
and likewise, because we deal with such diverse set of clients day in and day out, I would say that there's not a single day where there's no learning, there's no improvisation, and it's never boring, because you're constantly being challenged with various thought processes and situations, and it keeps you mighty awake, and you keep learning through the journey. So it's a phenomenal opportunity that we are in this place at a juncture where we can continue to sharpen our skill sets.
Thank you. Thank you, Karthik, and thank you, Shashank, for being on this podcast with me.
Thank you, Vasanthi. It's been a pleasure.